All right, so we are now recording for your viewing pleasure. So, Chapter 21, Disposition of Partnerships, Interests, and Partnership Distributions. So, as we've talked about this before, we had a chapter where we did non-liquidating distributions. It's basically, forming and operating partnerships. We talked a little bit about some of the distributions that end up happening. For the most part, when you start looking at and I'm trying to think here. When you start looking at the, how an organization goes through its life, obviously you start up, you build your partnership, and then after a while it starts going okay, and then after a while maybe it starts going down, and you decide that you're not going to do the partnership anymore. I've had one client where I've actually been able to take them through the entire operation, the entire life cycle actually it was a partnership from beginning to middle to end. And in fact, we just ended his partnership this year. So there's been some, there has been some, some activity in terms of that's really been kind of relevant to that. So we're going to talk a little bit about some of the aspects of this, and then we'll talk about how you dispose of it. Okay. So first thing, basics of sales of partnership interest. So what ends up happening is, let's back up for a second. And any of you financial planning type people who want to jump in, you can go ahead and jump in. But if I buy, 100 shares of IBM, and I purchase that 100 shares of IBM, the cost basis of the purchase is going to be whatever I paid for it plus any fees in order to acquire it. And then what's going to happen is that, 2-3 years later, I decide I don't want those 100 shares anymore. I go to the market and I sell the market. Well, everyone in this room can calculate that gain loss calculation very easily. Whatever I sold it for is my AR. Whatever I bought it for plus the fees is going to be my AB. And in the AR, any fees that I incurred to sell it is going to be a reduction. And so what'll end up happening is that you have this sort of this aspect there where you say, okay, AR minus AB equals gain loss, and that's going to be a pretty easy thing. Something you're going to realize with partnerships is that's not necessarily the case, even though in some ways it is. So for example, if I buy into a partnership, and we'll say, let's see if I can do this here. So let me make sure yeah. So we'll say that I buy into a partnership, and I'll actually do this here. And so when I purchase into the partnership, now how do we go into a partnership interest? I contribute cash. I contribute some property. We'll say that I contributed $100,000. Okay. And so what ends up happening is that I contribute $100,000 and I buy into the partnership interest. And then what happens is, we'll say year one income, we'll say it was a negative $50,000. And then we'll say in year two, we'll say it made $75,000. Year three, we'll say it made $140,000. And in year three, I take a distribution, we'll say for $40,000. Year four income, we'll say this year we we'll say that towards the end of this year, something bad happened in the organization. So instead of 140, we only made we'll say $110,000. And in year five, your organization is going to be forced to close down, and as a result of which you notice that they have $75,000 in losses. So if I were to, and this is pure chicken scratch at this point, okay, but if I'm to take all of this and kind of figure out what my distribute or what my basis is at the end of the year, I have a basis of $260,000. Okay. Um, Now, all things being equal, say for example, the business has to close down and I get no money for it. How would you think that that loss? I mean, first of all, would there be a loss on the closing of my business? And the answer is yes, there should be, because I put in $100,000. All this money that has happened, the 140, the 110, and these negative amounts, all of this income has been taxed to me. Okay, it's been taxed to me. I paid taxes on it, and so it's basis. And so how would that happen? Well, in a simple, plain scenario, and assume this is all about services, and everything is cash based. We do services. What would happen is I would get a long-term capital loss of $260,000. Okay. Now, what is oftentimes not going to what oftentimes is going to happen is, there's going to be a lot of confusion with this. There's going to be a lot. Obviously, I'm making this really simple, uber simple. Okay. You have income, money that's been brought in. You get to the end. There's $260,000. There's no money left in the organization. You don't get anything. I'm going to be able to write off $260,000 as a long-term capital loss. Okay. So now what we can do is that there's a couple aspects to this that can make things a little more interesting. We'll talk a little bit about how some of that does. So when they talk about the basics of sale for the partnership interest, because there's a flow through entity aspect of this. So in other words, with my 100 shares of IBM that I buy and then I go ahead and I sell it, no income has ever been attributed to me through IBM, other than maybe some dividends that I received. Now, dividends, because they come from current earnings and profits, I'm not going to be getting any additional basis off those. Instead, what's going to happen is it's taxed, and because IBM is a U.S. corporation, it's going to be taxed at qualified income rates. So it'll be taxed probably around 15% for most Americans. It's going to raise unique issues because of the flow-through nature, but if the tax rules follow an entity approach, the interest is considered a separate asset, and sell partnership would be very similar to a corporation stock, which is exactly what I've just done. That's exactly how I kind of suggested it. Is that, hey, if I have the $260,000, I sell it to somebody for nothing, I have a loss for $260,000. Okay. So if the tax rules use an aggregate approach, the disposition represents a sale of partnership's share of each asset. Now, I told you that it's a service organization. More likely than not, there's not going to be any assets in it. If there is, it's going to be like computers. It's probably going to be, some office furniture, and that's about it. We're talking maybe at the most, $1,000, $2,000 worth of stuff, especially if all we're doing is consulting work. So there's two different rules that we can actually do in order to figure this out. More often than not, we're going to figure it out using the entity approach. So seller's issues is going to be, calculating the character of the gain or the loss. And then you're going to determine the gain or the loss of the difference between the realized and his or her outside basis, which is exactly what I just told you here. When we have this one here, this $260,000 represents outside basis. Okay, so if instead of disposing of this, maybe we did have a bad year, I decide I don't want to do this anymore, so I'm going to sell my partnership interest to my partner's cousin. And so I'm going to sell it to him. It's not a related party transaction because the cousin's not related to me. And so I sell it to him, and say I sell it. And I'm going to sell it to him for $350,000. Okay. Now what happens? So it's kind of like how it is with stock. You have $350,000 that you're going to take, and so your overall gain. Now remember, this is realized gain that we're talking about here. It's $350,000 minus $260,000 is $90,000. Now, what kind of gain is that? And the answer to that is that it's going to be a capital gain, and the determination of whether it's short-term or long-term is how long have I owned the partnership for? Well, as you can see, I've got 5 years worth of income. So have I owned it for more than a year? Answer is yes. So this is going to be a long-term capital gain. Okay. The way this gets reported is that you're going to go on to Schedule D. And actually, I'll pull that up here real quick because this is actually an important aspect of this. Wait a minute. Okay, so for some reason, it doesn't want to work. Okay, interesting. Okay, hello, Bueller. All right. Oh, whoops. Oh, wow. It did not like the fact that I did that. My computer's been acting weird lately, by the way. All right, so this is going to be Schedule D, which will get attached to the individual partner's tax return. And what's going to happen is that, and I'll just kind of shrink this down a little bit. So this is going to be the long-term part 2. All right, so you have long-term capital gains are going to be part 2 of Schedule D. And see box 10, where you're going to have all transactions reported on 8949 with box F checked. Here's why. And we talked about this in the individual tax return spot, but if you have basis reported to the IRS, it's going to be reported on a 1099. It's going to be marked D for long term. If you have sales reported on a 1099, but basis is not reported to the IRS, it's going to be marked box E. E is an echo. If this sale is not reported to the IRS on 1099, you have to put it as code F. Okay, it's either going to be code F for long term, or it's going to be code C for short term. So you need to make sure it kind of goes into that right spot. Now, for the most part, most of you guys are probably going to be like, okay, that sounds like something really complicated that I'm not going to be dealing with. Actually, I had started to do some work on a sale of a partnership within the first year of my working in a tax firm. So knowing where this goes in the tax form is actually going to be kind of key. Okay. Now they have this thing called hot assets. And what are hot assets? No, hot assets aren't something that you stole from downtown, during the coronavirus and nobody was paying attention. Hot assets are basically unrealized receivables, and the right to receive payments are good to be delivered or services rendered. Another form of hot assets, they say for cash methods, unrealized receivables included, amounts earned but not yet. So for accrual basis, the accounts receivable are not considered unrealized receivables because the accrual method taxpayers have already realized the income. And that's what they're going to be saying about. Okay, actually, I got somebody who's asking a question. LOL. Oh, okay. Sorry. Sorry. Sometimes I say something funny, I don't even realize it. So the whole thing is that, so if you're an accrual basis taxpayer, accrual basis partnership, you're going to be recognizing the income as it's coming in anyway. So what's going to happen is that you're not going to have any unrealized receivables at that point. However, let's focus for a moment and assume that it's a cash basis taxpayer. Okay. Then you have any inventory items. They're going to be they include classic inventory defined by property held for sale. It also includes assets that are not capital assets or 1231 assets. Okay, so hold on a second. We're not going to talk about inventory right now. I want to talk about this from the perspective of from the perspective of accounts receivable. So go back to our example, and you start looking at some of this stuff, and you begin to realize that there are We'll say there's a total AR of $50,000. Okay, that's left over. So when I get done selling my thing to cousin Schmo over here, and I said, "Hey, cousin, you're going to go ahead and I'm going to sell this to you." We take a look at the balance sheet as of the date of the sale, and we'll say that this happened on March 31st of the year. And so when I talk to cousin Schmo about it, I kind of go, "Hey, look, there's an AR of $50,000. I'm 50-50 partners with his cousin originally. So what happens is that I have a 50% interest in this. Therefore, I have to take 50% of that, and this long-term capital gain is no longer a fully long-term capital gain. The way the IRS is going to see this is that you are receiving, excuse me, you are receiving, part of that $350,000 that you're getting is going to be, part of that is going to be the accounts receivable being handed to you, because guess what? Your company still had accounts receivable based on the work that you actually did, because the definition of accounts receivable is it's work that's been performed that I haven't collected money on yet. So 50% of that accounts receivable belongs to me from the IRS's perspective. Now, there can be a specific apportionment that's done. I would say it's a little risky to do that, because usually the IRS likes things to be clean and neat and all that sort of stuff. And then there's the aspect: did the account work that get done fully attribute to you, or did it partially attribute to you and partially to you? Sometimes it's not easy to do. My recommendation is always go ahead and just break it out by partnership interest, and then that way you don't have to worry about an audit as a result of it. And generally speaking, it's not going to result in anything massive. Okay, so you have the realized gain. So the way that we're going to do the recognized gain, so you're going to have the $25,000 that you have here. Okay, and then you have, and actually I'm trying to set this up right. Let's see, so I have, of this $90,000, so of this $90,000, $25,000 is hot asset. The $65,000 long-term capital gain. Now, what is hot assets going to be taxed at? And if you think about it, this makes sense. Say, for example, I didn't sell the partnership and we received that $25,000 income. How is it going to be taxed to me? Is it ordinary or capital gain? I'm waiting for one person to answer. All right, there we go. Capital gains. No. Sorry, it is going to be ordinary. It is going to be ordinary. And the reason why is because here's the thing. If it's ordinary income, that's how it's going to be taxed to me, because it's income in an ordinary course of business. So you're here and you have that. So this is going to be ordinary rates. And the way this gets reported on the tax return is generally what you're going to do is you're going to fill out what's called a form 4797. That's going to report a lot of that. And so boy, my computer is going really slow today. And so what's going to happen is you're going to actually report this on a 4797. And what'll happen, how this works out, you're going to put this into part 2 of form 4797. That's going to be ordinary gains and losses. Okay, so what you would actually do here is you would say hot assets in disposition of partnership. And then what would happen is, and I'm not seeing it because I don't see the top, it'll tell you the date acquired, date sold, blah, 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 and then how much assets you have You'd say, gross sales price, I would say is $25,000. There's no cost basis in any of that because you haven't been taxed on the income yet. That's why we're doing this whole thing to begin with. So you're going to fill it out. And you're going to have $25,000 on both of this, and then this part will actually get reported on your tax return and on line on 1040. So that's how we end up handling hot assets. Now, here's the question of the day: what if instead of AR, I have inventory? Say I also sell, in addition to this, we do services, but we also sell T-shirts because our business is so cool that our T-shirts are in high demand. Maybe we sell that, and I have $1,000 worth of assets I'm sorry, $1,000 worth of inventory. Well, obviously, it's going to reduce my long-term capital gain by that $1,000 that we're going to treat as ordinary income. So, I think the concept's not difficult. I think the biggest problem that most people have is how to execute it in the software. Again, because we don't know which software you're going to use when you go working in the field, it would be pointless for me. I mean, I could pull up 10 different versions of software, and all 10 versions are going to tell me different answers. So, anyways, so that's how they handle that. And this is what they're saying. They're saying, hey, look, process for tournament gain or loss. Total gain equals amount realized minus outside basis. Calculate card. Boy, it's like exactly what it's like. I know what I'm doing. So that's kind of what happens. So now we're going to talk a little bit about some of the issues. For the sales transaction, the new investor's outside basis will be equal to his or her cost of the partnership. So, cousin Schmo, who buys my my partnership interest, he is paid $350,000 for the investment of my partnership interest. Now, my original basis was $260,000. You can imagine this is going to cause a little bit of a problem. We'll talk a little bit about this later on, and there's going to be a way we can do what's called a 754 step up in basis, but we'll talk about that here later on. So, getting back to what the slides say. It says for the sales transaction, the new investor outside will be equal to the partnership interest they purchased. To the extent the new investor shares in the partnership liabilities, his or her partnership liabilities will increase his or her outside basis. Now, one aspect of this that we didn't talk about is, hey, Kevin, assume there's some debt involved. And remember, there's 3 different types of debt that we have, right? Non-recourse, recourse, and then we have what we call qualified mortgage interest. Okay, now, as we've said before, there's certain aspects of this that need to be taken into account when you're going to consider the amount realized, and you have to understand. So, say for example, I have $10,000, and this is in the entire partnership. Oops. Okay, so we have $10,000 of non-recourse debt. We'll say we have $130,000 of recourse debt. And mortgage, we don't rent the building. We rent the building out. We don't own it, so there's no mortgage debt. Okay, so recourse debt $10,000, non-recourse debt $130,000. Okay, so here's the thing. If I get out of the partnership, do I? And let's say, okay, so this is the entire partnership. And I'm trying to see how I want to word this question. To the partner. And as my friends in New York would say, use. Okay, so this is use. So obviously your partnership, your debt interest in this is equal to this divided times 0.5. But let's say on the recourse debt, you've gone ahead and you're going to be on the hook, and we'll say that you're on the hook for only 30% of this. Okay. In other words, your other business partner assumed more of the recourse debt on it, and the bank was willing to do it. But we'll just say it was at 30%. Okay. So The basis on distribution is what is my basis that I had received, that I had in this partnership? And the answer is the total basis that I actually had is this $260,000 plus the $304,000. Okay, so that is my total basis. Now now I'm going to have a situation where my gain looks like it's going to get reduced. Well, not necessarily. So the outside basis that you have in the partnership, when we do the gain and loss calculations, we're actually not going to use the loan amounts to increase that basis in order to get this done. That said, however, there is a potential problem here in that you're getting some debt relief. Okay. Now, when you sell your interest in the partnership, the non-recourse portion is it was never your concern, correct? There's no cancellation of debt for non-recourse loan because they couldn't come after you in the first place. So yeah, you had some debt basis that was going to be done with this, but you also have on your recourse loan, your recourse portion, you are having $39,000 of debt that's going to be eliminated. And so that's going to actually create a cancellation of debt issue. Now, we'll talk a little bit about this. If we have time today, we'll talk about this more in detail, but I just kind of want to bring that up as part of the problem. Now, getting back to what the slide says here, it says the outside investors' basis will be equal to the cost of their partnership interest. But say, for example, that the person who comes into my organization, they assume debt the same way that I did. They receive that increase in basis to their partnership interest based on the amount that they have actually based on the amount that they assume. So he assumed an additional $44,000 of debt. His debt goes up by his basis goes up by $44,000. So that's not something that I think is rocket science there. So varying interest rules, the interest increase when they contribute cash or property. Yeah, so what ends up happening is that, obviously, well, actually, let's go through the rest of this because I think some of this other point, and we can talk overall. So the partnership's interest decrease when they receive a portion of the distributions, and then the two methods for allocating income and loss of the partnerships when their interest changes during the year. So what ends up happening is there's obviously, and I told you we were going to do this on March 31st. If this is a calendar year taxpayer, there's going to be sort of an accounting conundrum that's going to take place because what will happen is for the first quarter, the business was operating as it has in the past, but for the next 9 months after that, it's a completely separate business. So normally what happens is that if you have a swap of partnerships at certain levels, the IRS actually requires that you go ahead and close the books. And so and we'll talk a little bit about that here later on. But basically, when you end up closing the books, it's almost like you shut the entire partnerships down and you started a new partnership. Even though the EIN is going to be the same, the partnership's name is going to be the same, all that other stuff is the same. But from an IRS tax perspective, you're required to do that, and we'll talk about some of the issues with that. So operating distributions are usually paid to distribute to business profits that can reduce profit, but can also reduce a partner's ownership. Operating distributions of money only. Obviously, the partnership doesn't recognize gain or loss in distribution of property. One exception is when the distribution is greater than the partner's outside basis. In that case, the partner will actually receive the gain. So in other words, getting back to this example here, say for example, if instead of $50,000, I took out $150,000, well, actually, hold on a second. No, let's not do that. Let's not do that. Okay. We'll say this distribution, what did I have at that point? We'll say I had $265,000. Say I took out $300,000. Okay. So what would have happened is I would have had, and actually in this case, if that were to take place, I would have to have so then I would have gain in excess of basis. So here I have $35,000. I've overdrawn by $35,000. So I would have to take $35,000 as a long-term capital gain. Okay. And that's how it would actually be reported in year 3. I'd say, hey, I took $300,000 out. I didn't have $300,000 worth of basis, as a result of which I'm going to go. I basically have overdrawn, so I have to take care of that. Now that's not assuming there's any debt issues. The debt that we're talking about here is not the same as the debt it would be in year 3, but assuming there's no debt issues, basically it's the same thing. I've gone above my basis, and as a result of which I now have to pay taxes on that gain in excess of distributions. I actually have a client right now that I'm dealing with that her partnership closed down, and because the previous CPAs weren't keeping up with the basis calculations correctly, it looks like she has a $32,000 gain in distribution. I said that's nonsense. There's no reason why you should have that. So we're trying to work that out with her in order to get that done. But it is something that you can see the importance of keeping track of basis in order to do this. I will tell you that a good majority of accounting firms don't. Usually we don't track it until we have to, and that's usually when it gets sold. And we do that for 2 reasons. Number one, it takes a lot of extra time that a lot of times the client's not willing to pay for. So why am I going to sit there and rack my brain trying to make sure that basis numbers are kept complete when the client's not going to pay me to do it? So I'm not going to do that. Now, when the client sells and I tell them, hey, you've got a gain on excess of, a gain on disposition of $40,000, but I think that because we haven't been tracking your basis for you, we need to track your basis. I need all your K1s, blah, 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 so on and so forth. Now I can actually go out and bill them for that. And if I tell them, you have a $32,000 tax event that we have to deal with right now, all of a sudden the client's motivated. Okay. So when you tell clients they're going to have a lot of pain if they don't do this, then they get motivated. Now, it sounds a little unscrupulous to do it that way, but guys, this isn't a charity. We do this in order to make money because, and it's not about profit. I'm not trying to talk about profit. I'm talking about compensation of our time. You're here in class right now at 7:30 in the morning listening to me talk the whole time. You deserve more than somebody who, is sleeping in. Okay. That's just my opinion. But and that's how that kind of works out. We bill our clients for the time that's necessary in order to make sure that that we get adequately compensated for everything that we do on this. And it's important, but does that mean that we do a slack job just to get money? No, that's not the case. But we do get paid for our work, and we have to make sure that we do that. Okay. All right. So distribution out of money. So we talked about that. Partner simply reduces his or her outside basis to 0 and recognizes gain. We talked about that. Basis in the remaining assets remains unchanged. Partner never recognizes a loss from an operating distribution. So there's no loss to be recognized from that, and that's just the way it works. Operating distribution that include property other than money. So partners must reallocate their outside basis to the distributed assets. And so what happens is that if you give a portion of, so in a sense, what they're talking about here is that if you distribute something other than money, it gets a little bit wonky. And, we've got probably about 20 minutes left. So I'm going to kind of go over this, but I'm not going to necessarily go into it. Order in which to allocate. So you got to allocate it to the outside basis, and you got to reduce the outside basis by the amount of the property that's being distributed. Again, like I said, I'm not going to talk too much into this, but the main tax issues are you got to determine whether the terminating partner recognizes a gain or loss, and then you got to reallocate his or her entire outside basis of the distributed assets. This is where, so for example, let me tell you an example where this can happen. You terminate the partnership, you don't have any cash, or one partner wants all the cash and one partner wants all the property. What happens is that there's a calculation that has to happen as a result of it. If you're getting all of the cash is different. The greatest thing about cash is that cash's basis is fair market value at the time. And fair market value of cash is cash, so there's no ambiguity there. Property is a different deal. So there's going to be certain aspects of it that we have to take a look at in order to make sure that we're not walking ourselves into a tax trap. So in theory, there's no gain or loss in the distribution, and the assets basis will be the same as in the hands, but it does rarely occur. And part of the reason for that is usually the reason why the partnership is terminating is because usually some of the assets that are in the organization have devalued. And so there, but some aspects of the assets may have increased in value. So it's you got to take a look at it on an asset by asset basis. Gain or loss in a liquidating distribution. Generally, partners and partnerships don't recognize it. Exception: gain. Partner does recognize gain when the partnership distributes money and debt relief, and the amount exceeds the outside basis. We've already talked about that. Loss: the recognized loss when the distribution consists of cash and hot assets. Recognize, when they're two, consists of only cash and hot assets, and partner's outside basis exceeds the sum of these bases of distribution. So the basis in distributed property, primary objective is to allocate the partner's entire outside basis in the partnership to the assets and the partner receives in the liquidating distribution. So for example, if I have a partnership interest, and we'll say that my partnership interest is we'll say that the interest in the partnership is $35,000. They're going to distribute as part of the liquidating distribution, they go ahead and they give me my computer. Okay. What will happen is that you're going to have, they'll probably hand me a whole bunch of cash, and they're going to say, and you can take your computer with you if you want. What's going to happen is I have to allocate part of that $35,000 in basis to the computer as part of the basis in that. In other words, the computer is going to have a basis value to me as a result of that. And if what I'm saying sounds like some alien language, let me know. But that's kind of what happens. So if you distribute, property and cash, there has to be an allocation that takes place as a result of it. So it depends on two things: the outside partnership's basis and the distributed assets relative to the partner's outside basis. The type of property is distributed: money, hot assets, and other property. Obviously, if we decide that we're going to discontinue the partnership and say there's not a whole lot of cash, so they say, hey, why don't you take half the inventory with you and I'll take half the inventory with me. You're going to have a basis that's going to be added into some of that inventory. And then what will happen is that if you decide to sell that inventory, that's going to be a reduction in the amount of gain that you're going to have as a result of that. Now, like I said, you have to be careful about this because the correct allocation needs to be used, or else the IRS is going to think that you're trying to play some funny business. So we want to make sure that happens. All right, so it looks like they're going to go through some scenarios. And so the first scenario they're going to go through is types of distributed. If there's money only and the partner's outside basis is greater than inside basis of the distributed assets, it's going to be pretty easy. Scenario one, distribution of money, inventory, rateabilized. So suppose he has an outside basis of 334, including a share of liabilities of 66,000. Blah. In a liquidating distribution, he receives $159,000 of cash and a fair market value of inventory of $49,000. Will you recognize gain or income? And the answer is yes. To prevent the conversion of the capital loss to an ordinary loss, he has to recognize, Greg will recognize a $60,000 capital loss. If the inventory distributed is also considered inventory in his hands, the eventual sale of the inventory will generate an ordinary income. If the inventory is a capital asset to Greg, a sale of the asset within 5 years of distribution will generate an ordinary income. After that, it's going to be a capital gain or loss. In other words, what they're trying to do here, one of the things that the IRS is concerned about when it comes to distributions and partnership interests, they don't like it when ordinary income gets converted to capital income, because obviously there's a reduction in tax on that. But they also don't like it when ordinary or capital losses are converted to ordinary losses, because there's no limit to how much you can take. So these are sorts of things that the IRS try very, very hard. It's almost like they've got three rivers that run right next to each other, and they're trying very hard to make sure that there's no way that the water from one river can get to the other river without a special rule or circumstance. So that's kind of why they do that. Okay. Scenario two. So as you look at scenario two is going to be Partnership's outside basis is greater than inside basis, but there's other property that's being distributed. Okay. So in scenario 2, other property included in distributions. The partnership allocates entire outside basis to distributed assets. Partner may increase basis of other property, not hot assets, but does not recognize gain or loss. So, for example, I'll make this simple. I have basis in my partnership of $250,000. Yeah, actually, let's look at we'll look at it this way. So there's outside basis, to the assets equal to the inside. Okay. Step 1 is to assign outside basis to distributed assets amount equal to the inside basis. And then step 2 is to allocate the required increase to assets with unrealized appreciation. And then you're going to allocate any remaining required increase to the distributed assets in proportion to their relative fair market values. And so what ends up happening is, say, for example, I have a very simple example. We distribute the partnership. I have a basis of $260,000. We have a piece of land that's coming out, and the land has a basis of $100,000. Well, my partnership basis, $260,000. I'm just getting this piece of land. So what's going to end up happening is the $100,000 minus the $266,000 is going to be $166,000. So that $166,000 is going to be allocated to the land, because it's the only thing that I've got. Now, if I had a piece of land, and then say, for example, I had another part of land. Maybe I got 2 pieces of land. I have one piece of land that there's the basis in the land is $100,000, and I have another one that's got a basis of $1 million, and the fair market value of each land is equal to $1 million. What's going to happen is that first I'm going to allocate it to outside basis to distribute assets equal to an asset's inside basis. Well, the inside basis is already there, so we don't have to worry about that. Step 2, allocate the required inside increase to assets with unrealized appreciation. Well, I just said one land is basis at $100,000 and the other one's at $1 million, and they're both worth $1 million a piece. So, in other words, the first piece of land is going to get more of that basis allocation in order to do it. Now, you might say, why would the IRS want to do that? The thing is that they don't want to have a situation where you're trying to create a loss. The IRS would actually rather you have gain reduction than a loss, because losses are actually harder to deal with. And so that's one reason why they kind of do it this way, okay? What if CSS makes the following distribution to Greg and a liquidation of his assets? And this is where they kind of did this. They said investment A, investment B, and then there's the fair market value, what would happen? And the answer is that he recognizes no gain or loss in the distribution. The basis and the assets are going to go up to this amount. So what they did is that they first of all, they did step 1 where they allocated it to the items, and then step 2 where they actually increased it to the fair market value of the items to make sure that it didn't go too far above. In this case, you had one asset that has a $7,000 unrealized appreciation. Then you have another one that's got a $3,000 unrealized appreciation. So the base is going to be allocated to those assets to make sure that that gets taken care of appropriately. Notice that the inventory cost basis is $43,000, fair market value $130,000. It stays at $43,000 as part of this whole thing. You're not going to you're not going to increase the inventory when you have the other assets that you can actually allocate things to. Okay. Because Greg receives property in the distribution, the distributed assets are less than Greg's outside basis. Scenario 2, he'll allocate his outside basis as follows. Okay. You have debt relief, amount, basis in CACS before distribution. That's his allocatable basis, and so that ends up happening. And then allocates the remaining basis outside of CSS. Yeah, so the basis, again, they're going to, basis assigned to cash, basis assigned to inventory. initial basis assigned to investment, and so then you have a remaining basis is going to be $29,000. Step 2, which is going to be the additional basis assigned to investment A of $7,000, and then to get them to the unrealized appreciation that we talked about. And then there's a remaining remaining basis left over, $19,000, and that's going to be allocated to each property based off of fair market value. Now notice, inventory is not here, and we don't do this to inventory because inventory is a hot asset. Step 3, remaining basis to distributed investments based on the relative fair market value. This is probably the most complicated math formula that you're going to deal with in tax. I mean, for the most part, I think it's pretty relative. So I don't think it's hard to figure out, but it is what it is. Thus, the investment in the basis in the investments are $21,120, and then $22,800 as we talked about before. Okay. I'm not going to worry too much about scenario 3, 4, and 5 because it's they're just kind of little playoffs on other things, and you're not going to run into them very often. I'll be straight with you guys. I think that when you talk about liquidating distributions, this is one of those times that you're going to be in tax that you're going to have to deal with this. You're going to have to go back to the books. And I think that it's very important. I'm going to share something with you guys real quick. When I was preparing for my data analytics class that I'm teaching at night, I actually found on my Dropbox a copy of every single college paper that I wrote in my master's program back in 2000. So I keep that repertoire of information for me so that and actually it really helped me build my class because I was able to go back and use my notes and say, oh yeah, that's what we talked about. And you might say, gosh, Kevin, is database work 20 years ago still relevant today? Yeah, databases really haven't changed much in the past 20 years. I mean, there's certain aspects of it that have, but the overall concept and theory of databases really hasn't changed too much because it's just the organization of data in order to generate information. And so my recommendation to you is keep all of your stuff, all these PowerPoints, all that stuff in your Dropbox, whatever it is that you have for your file sharing, and make sure that you have access to that in case somebody hands you something and you're like, gosh, I know we talked about this in class. I don't remember anything about it. Let me go home and or let me go outside and I'll look at it on my iPad while I stay away from things. Because one thing you don't want to do, obviously, is scare your coworkers that you're pulling out your textbook. So I always recommend keeping it though. I still have my textbook from when I took tax, even though the tax code is completely different than it is today. I still take it and I still use it for various other things. Okay. Then they're going to talk about disproportionate distributions. That's both operating and liquidating distributions can be disproportionate distributions. It's basically the whole point is point 3. It's to prevent partners from converting ordinary income to capital gains through distributions. That's a concern the IRS has. So they've come up with this method in order to be able to deal with disproportionate distributions. Again, this is one of those things you're really going to have to go back to look at to run through the examples to kind of figure that stuff out. And look, I'm going to tell you something. I've always believed that, when all of us go to the same university together, we need to stick together. Okay. At American University, I graduated with my master's out there, and we have sort of an unwritten agreement between all of us. We will always offer 15 minutes for free for each one of us to help each other through problems. Now, and be honest, it's not like I turn on the clock and I start saying, okay, well, it's 16 minutes. I got to bill you a quarter of an hour for it. That's not going to be the case. Now, if I have an American University person asking me about something and then they find out, that's important, we need more information on that, or we need more work on that, that's when you start getting into consulting agreements with that. I think you guys amongst George Mason University people, you need to be able to offer to each person that, hey, if you ever have a problem that you want to run by me, give me a phone call, and for the first 15 minutes, I'll try to help walk you through it. And sometimes we just need to be jarred on things. But I get calls from students all the time saying, Professor, I'm dealing with something that I know we talked about in class. I don't remember anything about it. Can you get on the phone and help me walk me through it? I'm very happy to do that. Okay, and I offer that to any of my students. You just have to call me at my business office or at my soon-to-be work office out at George Mason. All right. So special basis allocations, special basis adjustments helps eliminate discrepancies between inside and outside basis. Yeah, so the basis discrepancies arise in the following sale of partnership assets, and this is where we're going to talk about. We talked about the 754 election, 754 basis adjustment. So again, like I said, and I'm going to go ahead here, and I'm going to take this distribution. We're going to put it back to what it was. So I had $90,000 in gain. Here's the problem that you've got. When I built this business with my partner, I built up $260,000 in basis. Now, say for example, we've got assets in the total of $20,000. So we have $20,000 worth of assets. PREC. Whoops. Appreciation. And we'll say that $7,500 has been depreciated. So my total basis in this is now $1,250, of which I'm owner of half. My partner's owner of half. What ends up happening here is, we went out and we bought this basis, and then we have the depreciation that took place as a result of which, and then we have the distributions. But now that the person's bought into this partnership at $350,000, he is actually bringing in more capital to the business than cousin Schmo is bringing in more thing than his cousin did originally. So the 754 basis allocation is a way for us to make an adjustment to this to kind of correct for some of those issues. So without a 754 election, special basis adjustment is required in some cases where there's a substantial loss or distribution. But basically what will end up happening is we do a 754 basis election in order to make some corrections that allow us to get back to being 50-50 on things. So there's a 754. So there's a basis election that under 754, 743 subsection B authorizes adjustment for dispositions. 755 determines the allocation adjustment. 734B authorizes adjustments for distribution. So if I make a distribution, a severe distribution, and as a result of which I need to make a 754 election, we can actually do that if there's a need to do so. So it's when you sell the partnership interest and it's designed to give the new investor an inside basis in the partnership equal to the outside basis. And part of the thing that you're thinking about with that is, well, what is it exactly that you're buying here? So his outside basis is $350,000. We'll say that there's cash in the account, $150,000. Whoops, sorry. And maybe there's some inventory. Because I said that we didn't do that. So we'll say that there's some AR. Well, actually, it's a cash basis taxpayer, so we're not going to worry about AR. Again, so you've got all this. So total assets is $162,500, of which 50% belongs to me and 50% belongs to my partner. Well, when I sell my interest in that, I still have the 50%. That's what I'm giving to this guy. So what ends up happening is he has a basis of $350,000, but his inside basis is only $87,750. So the 754 allows us to do a step up in that basis in order for us to be able to sort of what I would call right the wrong. Where am I? All right, so the adjustment is equal to the difference between the insides and outside basis and the inside basis. The new investor's basis is generally equal to the cost of his partnership plus the share of any liabilities. Okay, when the new investor's basis adjustment is allocated to depreciable or amortized assets, the new investor will benefit from the additional depreciation or amortization, which is important because what happens is, if you think about it here, whoops, he has spent $350,000 for something that's only going to have about $12,500 worth of depreciation available. Okay, now there's certain portions of this is going to get allocated to cash, but that's what he's sort of buying into. And so what'll end up happening was this with this basis adjustment, it'll give him additional, it'll give cousin Schmo some additional depreciation that they can take as a result of this. Okay. So what is the basis adjustment for? Okay, so then they kind of go through a calculation here. Their calculation numbers are a little different than mine. I won't get into too much about that. So potential problem exists when the partnership distributes property of the partners and the basis of the distributed property is changed as a result of the distribution. Yeah, we're not going to go, oh, shoot, I didn't realize what time it was. All right, guys, so I'm going to go ahead and wrap things up. I want to stop the recording.